You're gonna do it?
You do it,
Questions of the week. Oh no, I did it the wrong way.
did it the wrong way.
Questions of the week. Who haven't done it 1,000 times, I'll get it right once.
Whoever's editing this, please put it backwards so no one can read it.
I'm looking at it. Yeah. Like they have the ambulance so you can see it in the rearview mirror.
There you go. Love it.
Okay.
What do you got, Dave?
We got a good one from a listener because we talk about it all the time. Cash on cash. So instead of getting too far in the weeds, what is it? Why is it important?
Absolutely. Cash on cash, very simple. What's the return on the money you've put into the building? The actual money, not the mortgage, not the deferred maintenance, like your closing costs is what we're going to look at. And so what is the return on your total closing costs? And in my opinion, it's probably the most important number because it is your cash flow. Yeah. Right? That is the number people care about, is what is my return on this building monthly or annually, but paid monthly in my pocket. So I think to start to break that down, maybe we should just touch on closing costs. I know we've talked about it in the past. We did. I think we did a questions of the week on it, but why don't you just run me through what are the closing costs? Because a lot of people will take down payment and then apply the cash on cash to the down payment, but that's not exactly
I had that just as a side, and the client said, well, I saw this deal and it was 12% cash on cash. And that's quite attractive. And then we get looking at it and it's like, oh, no, it's
see what they did.
They snuck one by you here. Let's talk about it. So down payment for sure, right? Land transfer tax, right? Cost to do financing.
Yes.
Okay, so we're not including the financing picture in it, but the cost to do it, there's a fee for the lender. There's probably a mortgage broker fee into that. There's, what am I missing? Oh, legals, right? To actually close the deal.
Due diligence fee cost.
Reporting.
Reports, appraisals, etc.
Yeah.
And then down payment.
Yeah, and what happens is almost always some of those are missing.
Yes.
And that throws it askew because the amount you have deployed, if it's truly 500 but it's showing 400, that would mean that your cash on cash looks better.
Yes.
Because you've put less cash in, but you actually haven't. You just haven't accounted for the importance of that.
Yes, exactly. So really getting fine tuning the cash out of your pocket. Yeah. Right. What is the check I have to cut on closing to close this deal? So there's going to be that, and then you're basically taking that and running a percentage on the cash flow. Yeah. Off of the cash needed to close. Yeah. And so this is what you can take and kind of compare to your bank investments or your stock portfolio or whatever you want to look at. Right. You can say, hey, bare bones, what am I making out of this thing? And that's where we kind of want to see, I always like to see at least a 5%. I think that's kind of rule of thumb. Obviously, there's cases where there's going to be much less, and there's going to be cases where there's much, much more. I know most institutional, so REITs, funds, things like that, they all have their set returns they're looking for. Right? So when you go on to name a REIT, go to their website, I'm sure they'll show their targeted returns or their estimated returns. So, and very high level, because REITs will do lending and whatnot to top that up. But usually they're looking to target buildings around that number as their cash on cash return, meaning after all the expenses are paid, the management fee, the management expenses, whatever it is, that's what's left at the end of the day, and then they can pay that to their investors.
And that's a good point too. I know we don't want to go too long on it, but now we have how much we're including in the down payment and all the capital required to close. Then you look at the expenses that we're including. And a lot of times there's expenses that are not being included.
Correct.
Which then shows you have a higher cash flow than you actually do. So you guys have seen our sheet ad nauseum. It includes all of the CMHC fees and stuff in there. The CMHC minimum requirements, so for repairs and maintenance, property management, all that fun stuff.
Guys, it's high school math. You got to show your work. Right? You have
to. That's a great.
Don't just show me the cash on cash return. How did you get there? What are the expenses? What are the income? What's the payment that I have to make? How has that been calculated?
And then the last piece is it'll show it with or without mortgage pay down, which you see we've included now because it ends up being a lot of people want that figure in, which I get, right? It's you said it, forced savings. It's paying the mortgage down. We want that.
It's a metric that is being returned, right? So at the very least, you should have those two because that is truly the return that you're going to be making on that building monthly. You're paying your mortgage, you're getting money. You can also look at general passive appreciation, or even if not passive appreciation, just hoping the market appreciates. What you can look at is saying, okay, and this gets a little bit more in the weeds. Maybe we'll do another episode, but I'm already here, so I'll say it. You can look at your rental increases at the very minimum, right? And then there's actually a ratio of vacancy you can look at as well. But you can say, listen, I'm going to have my rental increase of 2.2% in 2026. So you can then take that 2.2%, apply that to the cap rate, or take the income of that, apply it to the cap rate, and get an appreciated value, or a forced appreciated value there of what. So you can also include that if you really want to get creative. You're really trying to boost that return number. You can look at stuff like that. But anyways, we're on cash. So, but I think that's it. It's not a super complicated number.
Yeah.
It's as long as you show your work and you know what you're doing, you can get to that number. But it's a very good number to have.
I think it's really important. And the other thing too is, what are we trying to do in this, right? So we use it as a filter to decide what deals to look at and discuss. Right. Omitting things from that is not a healthy exercise. So you want to make sure you have all the true closing costs, all the true expenses, and then you can break it down into further subcategories.
And on my end, I even use it as a pricing metric.
Yeah.
Right. So when I'm looking at pricing these buildings, obviously we're going to use comparable market data, cap rates, et cetera, dollar per door. But then I like to work it backward and say, okay, this is what the market's telling me to do. Now let me look at it as an actual buyer and say, would I buy this? Because if the market continues to trend downwards, and I'm looking at data from 6 months to 12 months ago,
right,
I'm going to be skewed. I'm going to be trying to sell this building for too much.
Yeah.
So then I look at my returns, I look at my down payments, what I need, and I say, okay, as a buyer, am I hitting a minimum that 5% cash on cash or greater? And that helps me kind of filter the pricing of these buildings to say, I've priced it correctly.
Well said.
Yeah.
Hopefully that helped.
There we go.
Yeah.
All right. Thanks again.
Yeah. Add the questions in and we'll keep doing it.
That's it.
Thanks, guys.
Thanks, guys.